to episode 70 of Top of Mind with Hao and Chris. We're here to talk about how nothing's happened in the market in the last couple of weeks. So we can probably just wrap this pod early, right?
Yeah, it's going to be a 15-second.
15-second? No news. Nothing's happened at all. No, really. We have a lot to actually chat about today, and it kind of did result in a whole lot of nothing, which we'll unpack. A lot of volatility, but not a lot of actual movement if you actually manage to keep your eyes closed for the last couple of weeks in terms of just like market prices. So, Hao, over to you. Why don't you get us started here? Let's talk about how nothing's happened in the market.
Yeah, a bit of tongue-in-cheek there, and it's really describing the S&P there, where it was down 19% in mid-April, and it's now flat, slightly positive for the year, which, there it is. Nothing really happened. If you slept and missed all of April, you would have seen your accounts would have been where they would have started the year, if not slightly better, which is... That's how you probably should view investing, right? We've been trying to say, hey, try to ignore the headlines. I know how hard that is on a personal level and a professional level, but things like this happen. We're not all clear from a headline risk standpoint, but the stock market is flagging and all clear. Nothing happened.
Do you think we hit bottom? Are you making the call? Whatever day that was, the
April
8th. April 8th, yeah.
Yeah, that was likely the bottom. At this point, since we're 3% away from our previous highs that were set in mid-February, I think anything new here, it could be tariffs again, but I think that was the bottom for this particular risk. I don't know how to really break down the categorization. I just don't see another sell-off and giving people another chance to buy lower happening with the same headlines.
I tend to agree with you. I think we hit bottom. I think it doesn't mean that there won't be more, news or not great news coming out, but I think that the fall, retesting that low, I'd be surprised if we retest that low.
Correct, yeah. It'd have to be a new shock to the system, right?
Yeah, a new black swan event. Yeah, exactly. Okay, so you are saying, geez, I'm just looking at this JP Morgan chart. Yeah, down 19% for the year, and we are flat as of now. And just talk about how quick it was.
This was a 5-week recovery.
Unheard of.
We go back to 2018, 2019, the last time we had this tariff drama. The market was pretty shocked too, right? It was down 19% that December in 2018, and it fully recovered by April 15th, 2019, which is almost exactly 8 weeks. And it shows you how quick these things are if it's like a headline risk, right? So I've been talking about pools of risk, like what type of recessions we get, cyclical, structural, and Goldman put out a new one called event-driven risk. This one started off as the market was thinking this is going to be a structural issue, meaning the last structural sell-off we had was the great financial crisis, the housing crisis, right?
Right.
Loans blew up. Structurally, we were damaged. We had to fix the banking system and basically rework it from the ground up. This was similar, or heading to be similar, where essentially 150% tariff, we'd have to onshore basically our whole goods economy, right? Like we import a ton of stuff from China. And to rebuild all those factories and find able-bodied workers, that was going to take years to really come to fruition. But then tariffs paused, deals are made. Again, not many deals made, but the market is pricing in as if this ended up maybe being a bluff. Maybe that might be a little bit too, stark language, but it seemingly feels like the market is calling a bluff here.
Well, look, the market is definitely pricing in what I think they thought was going to happen during Liberation Day, which is roughly a 10% tariff across the board, which seems to be where these deals are falling, right? The UK deal had that. I'm not sure about the Saudi deal, actually, but and then we'll see where China lands. But the market is basically pricing that in. And then there's exceptions, right? There's carve-outs. There's carve-outs for certain goods and whatnot that come in. So, the real effective tariff rate, we think lands higher than it was before all this, but dramatically lower. Mm-hmm.
Yes. And that's where the positive stock market reaction is we're in a tariff environment now. And I think that's probably the given, at least 10% across everything.
Yep.
But it's not 150, not a 90, not a, whatever that Liberation Day chart showed. Mm-hmm. It's not as extreme as what the initial reaction was, or at least what the initial announcement was, right? The reaction was to that announcement. We got to take these presidential executive orders seriously. And that's what the market did, right? It reacted to what that crazy chart showed.
So, okay, so April 8th was the bottom, is what we're saying, and I agree with you. I mean, I think we probably, if we retest those lows or blow through those lows, it's something else.
Correct.
It's not this again, because I don't think we're going to turn back up tariffs. I think we're in this stage of kind of negotiating trade deals and whatnot, and then finalizing this stuff.
Yeah, and I think what we're trying to train people is there's an expectation of bad news, but when the reality sets in and it's not as bad as expected, markets shoot higher. Mm-hmm. So you could still get bad news after bad news, but if it's not as extreme, like in the structural recession case, that's a positive reaction, even though it might be completely confounding to you, especially if it went to cash, which we should talk about. But people were always telling us things were going to get worse. Well, we were saying the opposite, kind of, right?
Yeah. Well,
not
invest as if we don't know, right?
Yeah.
I mean, that has to be the theory here, because we don't know. We don't know how far down something goes, or how far down the market goes based on an event. We don't know when it turns around. What we do know is that history tends to repeat itself there, and things do turn around. When they do, they turn around very quickly, right? We've said on the pod a couple of times, the best market return days happen within 2 to 8 days of the worst days. And so you have to just be in for those periods of time in order to get that up return.
Correct.
Because that up return on that day is propelling most of your return over long periods of time. It's pretty wild when you really look at the data.
I saw someone took it to real extremes. They broke down the intraday timing. And if you weren't invested in these 60-minute windows of the stock market, you would have been lagging by about 70% of the market's return, or the market's rebound, you would have missed. Because remember that one day was Trump tweeted, buy now. 2 hours later, they announced the pause.
Yeah.
Market was up. The NASDAQ was up 12%. S&P was up 9%.
Yeah.
You missed that little window. You're still negative 8 versus a negative 3 here.
I heard that too, and I wish I could give credit to the source of that, but yeah, to restate
that seems extreme, doesn't it?
So the stat, I believe, was you only needed to be invested in, I believe it was specifically the S&P. So you only needed to be invested in the S&P 500 for a grand total of 60 minutes in order to get all of this upside return since the bottom. So it's not like a couple of days, because it all moves so quickly, and like overnight, right? You had these big jumps, and so that's considered, you're in and out. That's 10 minutes or whatever.
Yeah, we call it a gap up, right? Like
gap up.
It's not an auction where the guy's yelling. It's like 101, 102. It's like you're competing against a guy who's coming in and saying $100 bid, then all of a sudden jumping to 150, 200. We all know those guys who just like, I have this money to spend. I'm going to bid everything up to that point. There's going to be no walk up.
Do you want to talk about the drawdown here? You've got this in the deck. This kind of sets up this recovery, but I don't know if you wanted to touch on this. Yeah,
the lows were April 8th. The NASDAQ was down 23%. The S&P was down 19%. And to be official, the S&P needs to be 20% down for a bear market, which we think this was a bear market. Mid caps were down 22%. International was down 14%, and then Probably the worst performer was small caps, the Russell 2000, down 24%.
And then 5 weeks later, we are almost back to the highs.
5 weeks. So a little bit ahead of, there's 3 weeks left to kind of mirror what happened in 2018, 2019. But this is a fast recovery. And just describing the line, the bottom from 4.8 to the very next day, big, sharp run up. And I think that 60-minute window that Chris was talking about, if you were an investor during that time, or if you sold on the way down, yes, you might have missed the bottom, but where's your buy-in window, right? Like, where's your green light? What are you looking for? And I think, we're, again, not here to say, told you so anything, or not even to say this is your window, but this is kind of the folly of trying to time the market.
This is just wild how fast it recovered. I mean, this reminds me of COVID when it was just falling and falling and falling and falling. And then all of a sudden they come out and they say, we're going to do all this stimulus, and they just rocketed back forward. And like the bond market was breaking, like everything was breaking in COVID, right?
Yep.
And then I don't remember that recovery, but I want to say by like mid-year, we were back to normal.
Yes, it was. So the bottom was March of that year, and it was recovered by August, fully recovered by August.
And this was, I mean, this is like, that was actually economic stimulus. I suppose this is the same thing, right? You pull an economic engine, or you tariff an economic engine, which would be the reverse of stimulus, right? You pull money out of the economy. Yeah. It's a tax, and then you reverse that. I suppose the same thing in a way happened. Yeah, wild. So okay, so you've got on this chart here. Yeah, just maybe walk folks through this chart, because you've got like international at 0 and so on. So like, let's talk this through here.
Yeah, so this is just measuring the percent off high, and through Wednesday of this week. This is May 16th on a Friday.
Yeah, thanks.
11 a.m. Pacific. So the Wednesday, it's kind of been flat. It's been green every day since April 8th, and well, every day except for one, right? Out of the last 20 trading days, 19 have been green.
I think that's right.
Yeah.
Yeah.
So and there's still fear in the market. Not according to the VIX, but there's still fear if you were looking at the headlines, right? Like there's still worry there. But this is a percent off high chart that I just wanted to measure where the bottom was, and then where we were, how much we need to recover. So 0 denotes that we're positive for the year.
Right. Thank you.
Setting new highs again. S&P and the NASDAQ are 3% away from those February highs. The mid-cap index is 7% away from its previous highs, and the small-cap index is 9% away from its previous highs.
So based on that, so larger companies have recovered faster, smaller companies, in that order, right? Larger has recovered faster, medium has been slower, and small has been the slowest of the publicly traded world. What's your read on that? Do you think that the market is mispricing this? Or maybe a different question. Who are the real winners and losers of this environment that we're going into?
Remember the narrative? And we were, again, mea culpa there, we were perpetuating some of the narrative of small companies, more domestically domiciled. Well, they still import things. Right. And I think they have shown to be more sensitive to not only that, but to interest rates as well.
Mm-hmm.
Higher interest rates hurt these companies probably more than anything. The amount of talk about deregulation, right, the frenzy of deal making going on, throw that out the window if rates are pushing 4.5%.
Yeah.
And I think that's the biggest issue with these. So there, again, we as a firm think there's value there, but there's a lot more risk, right? So the next risk that we're probably seeing is the heightened probability of recession, right? We still have tariffs on the table. The stock market is acting as if that's something that's currently behind us, or at least the uncertainty is behind us, right? We know we're getting a clearer picture of what the tariffs are. The next thing, recession, small caps, unfortunately, are more sensitive to that, but they're more sensitive to lower rates, right? Like, what do we get in recession? Generally lower rates to spur the economy. Small
Right.
caps generally lead coming out of recession.
So let me ask you again, because I want to go a little deeper.
Yeah.
Who are the real winners and losers of this new environment that we're in? Which, let's just go to say that we are in a 10% tariff environment with exceptions, and
Yeah.
that we are in kind of a same interest rate environment, right? The Fed will probably cut 2 to 3 times in the next 12 months, right?
Yep.
That's what the market's saying.
Yep. 2.5 times. So yeah, right in the window of 2 to 3.
There you go. Subject to data. And so, like, what do you think? Is it
I see.
large? Yeah.
Yeah. It's large cap. Who name a small business that was able to go to the White House and say, "Hey, Mr. Trump, can you give us an exception on our goods?" Who has done that? Apple, right? Apple could do that because they're a multi-trillion-dollar company, and Apple gets an exception for iPhones, and is that fair? I don't know, yeah, but Apple's an important piece of our stock market until they get that. NVIDIA got exceptions, and more recently, NVIDIA got quite a few impediments taken down, right? They were not allowed to export to China under the Biden administration. Now that market's opened up again for them. So these big companies have been the biggest benefactors of some of the carve-outs and some of the exceptions that are made, at least initially. It does look like, unfortunately, smaller businesses that really can't get the residents here are going to have to figure out ways to tough this out, which is, to me, inherently unfair, right? Because if I had a small business that was doing smartphones, which probably would be a bad business decision, I wouldn't be able to talk to the Trump's administration.
Here's what I'm thinking right now. I'm thinking about, like, name a small business that is, what I'm going to look up here is, here, let's see, Crocs.
And proxy in, yeah, small companies, small publicly traded companies with what I just said there. Because, yeah, the CEO of Crocs isn't going to get time with the president.
Yeah, I mean that's kind of what I'm trying to think about here. So this is a $6.5 billion company, is Crocs.
So mid cap, yep.
And year to date they're down 18.5%.
So no recovery.
I mean, they were down 37% as of April 15th, so they've recovered.
So there's still a bit of pressure down.
So let me do it a little differently. The percent off high is 26%. I mean, what's another small one? What about like Krispy Kreme? So this is obviously a donut company. Okay, interesting. Krispy Kreme is they're 73% off the high. That's a weird proxy. Maybe something else is going on there. I don't know. I'd have to look at that further.
Krispy Kreme is probably not the best investment.
How about Yum Brands? Maybe Yum Brands is too big, though.
Yeah, Yum Brands is big.
Yum Brands is down 9.5 off their high.
Okay,
that's an outperformer, and they're
about
pretty big.
Deckers Outdoor, DECK. They make Uggs.
Deckers makes Uggs. Okay, they're down 42% off their high. Recovered a ton. They were down 55%, so they've recovered. What about Birkenstocks? Birkenstocks went public a little bit ago. Birkenstock is down 10% off their high. Okay, interesting. So they bottomed. I'd call that a best performer. They bottomed down 34%, and they're down 10.
Oh, I see the point you're kind of making, though, or maybe correct me if I'm wrong. Is like the recovery index wide looks great, but it's probably led by the Mag 7 again.
Well, what I was trying to figure out there is your point is small business will struggle more because they can't fly to the White House and say, "Can you exempt my product?" And so it's like, well, I suppose what that would suggest is here, better comparison. That would suggest that Nike has an upper hand over like Birkenstock, right? Like that's what that would suggest. Let me boot these food companies out of here. And now we're looking at Nike, Birkenstock, Deckers, which is Uggs, and Crocs. And okay, Nike is 35% off their high. Birkenstock is 10% off their high. Maker of Uggs is down 42% off their high, and Crocs is down 26.
Yeah.
So Nike's kind of square in the middle. I don't know. I was just trying to reason a case for, is that a true thesis that big business can get accepted, and also they have the cash flow, so they're not as
sensitive
impacted.
to rates.
Yeah, interest rates.
And I think the other thing is there's other things, right? With Microsoft's earnings, I think it was apparent that services led the way, cloud computing led the way.
Yeah.
You don't tariff those services, right? There's no hard good to tariff there. That's why the Apple iPhone carve out was so notable, right? Because out of the Mag 7, maybe with Tesla and obviously NVIDIA got their exemption. Tesla got quite a few exceptions too.
Yeah.
And anything so all those big companies that weren't predominantly service related were pretty much spared. Maybe Amazon was the other one that might have had most of the issues in terms of, because there's such a big retail exposure to it, right? So I think of the Mag 7, there's been quite a bit of jostling that worked out in their favor.
Let's look at percent off high for Ford, GM, and Stellantis, which is the maker of like Jeep and what else do they make?
Dodge.
Jeep, Dodge, yeah, that kind of family of brands. All right, so GM is down 16% off their high. Ford is down 25%. Stellantis down 53%. Geez, interesting. And these are all kind of similar companies that are all competing in the same space. Highly, highly affected by tariffs, though, because of their supply chain. All right, interesting. Interesting.
So basically, I'm arguing that we're picking winners and losers without a real free market balance to it.
I guess the other one I want to look at here, and then we'll move on. IJR versus IWM. So IJR is the S&P small cap index for our listeners, and IWM is the Russell 2000. And how can you explain the difference between those two for our listeners?
Yeah, the IJR S&P 600 is basically all the profitable small caps. So if, the index kicks you out if you don't make money. The Russell 2000, 60% of it is unprofitable businesses.
And so when you get what traders would quote a junk rally, the Russell 2000 does really well. So like a junk rally was the 2021 rally. Remember the COVID rally when like Zoom and everything was going crazy? 2021?
Zoom, Peloton.
2020.
2020 leaking into 2021, yeah.
Yeah.
Yep.
And so you had the Russell go way up because these unprofitable companies were absolutely just exploding in value. So these will kind of beat each other in different periods of time. Would you want to guess what they look like so far this year?
I'm going to say evenish. Even?
Yeah, you're right. So year to date, the S&P small cap index, which again indexes towards profitability, is down 6.27%. The Russell 2000, which 60% of those 2,000 components are unprofitable, is down 5.59. They're not even a percent apart, and they're basically the same. And their percent off high is also the same. Russell 2000, 9.22 down. S&P actually down more, 9.98.
Yeah, and
I don't know. Can't make sense of it.
Yeah, maybe you're throwing the rates. The rate story is throwing the baby out with the bathwater there.
Yeah.
But small cap has been struggling. Probably the last 4 years, there is a time when small cap wins. And I think you don't have to look too far back. It's 2018, 2019, and 2020, I believe.
Craziest thing is on your next chart here, the EFA is up 14% year to date.
Yeah.
I mean, that's wild. That was not predicted.
No. And I think tariffs would not only hurt the U.S., we would think there was an outsized impact on international. That's not the case. So it looks like if this is sustainable, it's only been one quarter to be, not even a quarter. If it's sustainable, these companies would have to back it up with earnings growth. There was a reason why. There's a reason why international had struggled so much.
So really good point, because the market, I mean, so forgetting about international for a minute, just coming back to U.S. markets, what the S&P is pricing in is effectively no earnings loss, like no change. Basically, whatever you said you were going to do, you're going to keep doing because stocks are more or less priced the exact same. That's interesting to think about. I mean, there was a lot of pull forward demand. People were buying stuff ahead of tariffs out of fear. So I know that was showing up in recent earnings reports.
Yeah.
But that's an interesting thing to think about.
Yeah. But it shows you, we've highlighted international in client meetings too. It shows you diversification outside of the S&P year in, year out, right? Just because an investment has done poorly doesn't make it a poor investment.
Yeah.
You got to have exposure everywhere in case things like this do happen. Who would have expected that? But aren't you glad you held in international if you did? I know a lot of people didn't, but you know what I mean? Like, you see, I think you know what I'm saying is you got to hold some of the losers sometimes because they sometimes become winners.
Let's shift to the next section here, because I think that just looking at the charting and looking at the data, it's just overly rosy, right? It's like, oh, cool.
It looks great, yeah.
It looks great. And so, you've got a lot of stuff in here, just like what's still in effect, and what are some of the risks just moving forward in like GDP data. And why don't we just spend a minute here?
Yeah, to be clear, there's always going to be reasons to sell, right? We've always said that. Like,
sure.
The wall of worry is always going to be there. There's always something in the world that says, hey, things are going to get worse sometimes. But majority of the time, right, we've been right because we're just playing the odds, right? It's 60% of the time the market's up, right? The 67% of the time the market's up. So if you veer from that, you got to have a really strong case for that. And even in that really strong case scenario, you're still going to be wrong. So this is more of reasons to sell, but I guess more apt to say more reasons to be cautious, right? Baseline tariffs universally are 10% still, with few exceptions, right? 30% tariffs on Chinese goods, which Walmart yesterday said 60% of their merchandise is imported from China. They're going to have to raise prices next month, right? Unless a deal gets done. Very few trade deals have been made, right? The UK is a done deal. That's probably the only official one. China and India have temporary truces. So the goal was 90 deals in 90 days. It's looking like 9 deals in 90 days if we're lucky. I don't know. I don't know. China's the big one. If you strike a deal with China, you're probably set. The U.S. deficit is on track to be $30 billion higher than last year.
Hold on. Can we talk about the Saudi deal real quick?
Yeah.
Just
I typed all this outline before the Saudi deal did be hit headlines.
Stuff happens quick these days. Sounds like we got a free plane out of it, so that's great. Oh man, but no, really, it's looks like there's a pretty big deal to sell goods out to the Saudis. It's like military stuff and arms and that kind of stuff. But what's your read on the deal, and do you make anything of it?
Yeah, $152 billion arms agreement. So provided by U.S.-based companies. There's a data center agreement, which might be valuable, but again, the concern there is data centers, right? We're sending.
We need them here.
We're sending, potentially, confidential information to sometimes adversarial country, right? I think that's some of the issues. So, and again, cultural things aside, is Saudi Arabia has a hot and cold relationship with the U.S.
Yeah. Yeah.
Probably to say it as nice as I possibly can here.
Okay. So kind of, I guess, not a nothing burger, but not, not a big deal. I mean, I guess they're not a huge economy that we trade with. So to your point, it's China is what we need to see, and probably India too, but it's China. That's what we need to see.
Yeah, well, they're a big OPEC country.
Yeah.
And if they can increase their inventory in oil, which they have, right? Oil's $60 a barrel, which actually hurts us. We're an oil producing country. I don't know if I could stress that enough. Is U.S. is a net exporter of oil, and if oil drops below $50 a barrel, you're going to get a lot of oil execs visiting the White House asking for exemptions or subsidies.
The next fly-in.
Yeah.
All right. So the deficit is going to be higher.
Deficit.
You telling me Doge didn't do anything?
Doge is claiming they saved about $150 billion, and
Okay.
I think if we take their word, they did spend about $125 billion to make that $150 billion happen in the form of like severance and early exit packages.
Okay.
So, assuming that we could keep that $150 billion savings, that's kind of short of the $2 trillion goal that we had.
Yeah.
Despite all that, where the U.S. as a whole is expected to spend $300 billion more than last year. Already, we're in a debt ceiling fight with the Treasury Secretary pushing Republicans to raise the debt ceiling again in July. So that doesn't happen. We're looking at another government shutdown potential.
Maybe I look at the Doge thing as kind of good news in that they didn't immediately go in there and find $2 trillion quickly. Like it wasn't like, there wasn't as much waste and overlap as maybe previously thought. Maybe I don't know if I'm spinning that, but do you think that could have been what happened there a little bit?
Yeah, for me, I think the waste isn't in the employee side. I think the waste is in unfortunately, the spending side, the what we pay to hospitals and the healthcare system through Medicare, right?
Yeah.
Like the cost of operations in the U.S. is probably the issue versus who's funding it. Like take the funding out of it, right? You go to you heard of medical tourism, right, Chris? Like people go to Lithuania to get hair transplants or go to some Croatia to do their teeth because it's cheaper to fly to Europe, get a dental thing done, than do it here with insurance in the U.S. I think the cost of the medical procedures is the issue that the government does pay. And I know once you say, hey, we got to cut Medicare, I think Medicare spending, it's like touching that third rail, but the level of nuance that it requires to go a level deeper there, if you're following me here, it's the cost that these hospitals are charging, these healthcare insurances are charging, that is the issue.
Well said. And so, you got to go further than just, we're not going to spend that on Medicare. You got to go all the way back to hospitals charging the insurance companies and the insurance companies that are billing. And you've got to really start at the root cause. You can't just cut Medicare spending, but ultimately that should flow through. I mean, that just helps everybody. I mean, I fully agree with that statement. Like medical stuff is so expensive here.
I know that there's an effort to, lower drug prices here in the U.S.
Yeah.
To be, Trump signed this order that that pharmaceutical companies can't bill more than the lowest country's rate for that same medication. Pharmaceutical companies were down 5-ish% during that time, during that 1 hour, and they recovered and were up 5%. Because someone read in the order that it was voluntary.
Oh, geez.
Yeah. I think in practice, though, too, if let's say $100 dosage for diabetes medicine is in Mexico, and we charge the pharmaceutical company charges $500 in the U.S. Well, from a business standpoint, would you lower your U.S. dosage or would you raise the Mexican dosage to $500? You know what I mean? So I think that's a simple thing for the pharmaceuticals to fix is keep prices where they are in the U.S., just raise them everywhere else.
Yeah, interesting. Well, I hope they don't do that.
But yeah,
yeah,
little nuances required there. I'm not attacking Medicare. I'm not attacking that support that people need for medical services. It's just the medical services themselves are probably the issue, that we have so many integrated things that are going to fight, right? The nurses union, the American Medical Association, like there's so many interests in there to keep those jobs well paying. In a lot of those cases, deservedly so. It's just, why is it cost $100,000 for a knee replacement in the U.S. when it costs $600 in Japan? Like that, where is that extra? Where is that extra cost going to?
yeah.
And it's no wonder why we spend so much on Medicare. I thought, I don't know, maybe too optimistically, something like a Doge should fix that. Mm-hmm. And even more simpler things like, I don't know, you probably have a lot of construction going on, road construction going on in your town, and it's painfully slow, right? And how much is it costing us? So those are the efficiencies that I would have wanted out of Doge. That it doesn't seem like it's the case, right?
Isn't the you wouldn't know this because you're not up here in the Seattle area, but they're putting in bike lanes everywhere in downtown Seattle, and I think that they famously said that it cost them $1 million a mile. Yeah, $1 million a mile to put in a bike lane.
Remember when Domino's was will fill in the potholes for your cities because the cities themselves couldn't figure out how to fill potholes? So simple things like that is, I think, where most Americans, hopefully agree with what I'm saying here, is not the spending, but it's like the things that aren't getting done, right? Yeah. We have a Costco coming up like 2 miles down the road, and they have to expand the lanes. So they put up these cones to block the lanes, but I've seen zero construction going on, other than everyone's forced to merge because they closed off all these lanes for a potential expansion, and that's going to be that case for 2 years. Why cordon off any of that? But that's just kind of the MO of local and big government in that respect. Like, yeah. I got to be super careful what I'm saying there, but
just go slow. Yeah. I agree with that.
Yeah.
All right, I took us down a rabbit hole. So GDP, you were saying GDP?
GDP was negative 0.3% in Q1. So if we get another negative GDP read, we have the makings of a technical recession.
Yep.
But again, I think that might have been the idea of this administration, is bring rates down. We pay, in interest alone, we pay $900 billion in just interest payments as a country. Yeah. We need to refinance a lot of debt. I would love to refinance, my house at lower rates. Similar thinking to the U.S.
Inflation.
Yeah, inflation still well above target, 2.8. I know headlines are saying 2.3. That's because gas prices are bringing everything down, which is relief to people. I get that. But the Fed is focusing on that 2.8 number because they could control that, or at least slow spending in those areas, because that 2.3 is what we call headline inflation. That includes food and gas. People are going to buy food and gas no matter what rates are, right? Like, they're not going to slow down those expenditures. So that's another impediment. And the next one is the 10-year Treasury is stubbornly high at 4.5%. We ended the year at 4%. This is a big issue because mortgage rates are tied to this rate, right? 4.5%. Treasury rate is currently meaning 6.8% mortgage rates, right? And we can't fix the housing market with near 7% rates. I don't see a way out unless people or sellers dramatically lower their selling.
Well, all right. We'll see how all that unfolds, I guess. I mean, I think between now and probably the next 2 weeks, I think we're going to see a lot more trade deals announced. Hopefully we do, right? Hopefully we can get some finality out of this and just move on. As you pointed out earlier, the market has kind of moved on. And so hopefully we get the data behind that so that we can just kind of carry forward here versus, reverse course if the market doesn't hear what was already being priced in. But further, I think you point out a lot of good things here. Like we need, hopefully we don't see GDP negative. Hopefully we see inflation continue to fall. At some point, interest rates got to fall. They're just stuck.
Yeah.
Maybe it causes a risk. It not causes. Maybe we need to have a recession for rates to fall. I don't know.
Yeah, we don't. And I think all those people cheering for a recession during the heat of the tariff war, I think they're, one, just being a little bit idealistic, because you just can't stop layoffs at 5%, right? Like it's Microsoft's laying off and other firms are laying off. They're not coordinating with each other, right? And 4% unemployment can easily ratchet up to 7% unemployment. And there's no stopping that, right?
That's what's interesting right now is that you've got a huge incidence of CEOs saying the word tariffs on
more than AI
calls. Great. But it's not coupled with layoffs. And so they're talking about it. Not yet. Microsoft just announced, right? I think it was 3%, 10,000 people. So not yet have we seen companies start to shrink their workforces, but CEOs on earnings calls are saying the word tariff a zillion times and like it's causing uncertainty. So it's, where the rubber meets the road is, are you now shrinking your spend to try to keep margins in check because you don't know about the future? Again, haven't seen it yet. We'll have to continue to wait and see on that.
Yeah. It's plausible though too. Like it's something a responsible CEO would do, right? Okay. So where markets are priced now, let's assume like we're back even, but we're back even with the overhang of tariffs, right? Like the very least 10%. So you got to ask yourself if this market is fully valued, overvalued, or undervalued still, right? Does it even matter, right? I think what we're trying to say is, if Chris we're having another 529 decision, is he going to wait for things to pull back to put that money to work? Or just close your eyes, plug your nose, put money to work, and hope for the best in 5 years, right?
And stay off social media.
Yeah, stay off the headlines. I know people read headlines for lots of reasons, but somehow put up a wall between your money and those other reasons that I mentioned, if that makes sense. People aren't going to be successful doing it. I get it, but we had to fight that internally, right? To go to cash. Well, we didn't have even that discussion, but like we saw our accounts go down. It's not like we were impervious to down markets either.
Yeah, of course, everything swings.
And it's an emotional thing. So I think it's a skill to get over that, or not get over it. That's probably the really bad word to say, but to somehow look beyond it, right? And I guess in the heat of it was probably it's behind us. It's easier to talk about now, right? In the heat, we're honing in on this because it's still somewhat fresh. Mm-hmm. And one of my predictions is people are going to forget about tariffs by the end of the year. I'm still holding to that because if we're going to look at Google Analytics there, people are going to forget about tariffs.
I am so curious on the last couple of weeks has felt like a year, and I'm just so curious when we get past the first half of the year into the second half. It's like, what's going to be the tail of the tape here in 2025? When we're sitting here at Christmas doing our podcast, I'm just like, I cannot predict that. So yeah, we'll see where this lands. And more importantly, I think we do get certainty around kind of tariffs and policy here in the short run, but then more importantly is how does that actually impact things for the rest of the year? That's what's going to be interesting. So yeah, we'll have to just wait and see.
Yeah. So,
Do you have-
yeah, the rest is kind of news in that vein. You're always going to continue to see not so positive news because, surprise, so positive news doesn't generate
'Cause-
clicks or sell newspapers, right?
Because you'll click, exactly.
So I think find ways to ignore what's the negative sides of things and kind of think about what could go right when you're invested.
I agree. Okay. Should we leave it there?
Yeah.
All right. Awesome. Thanks everybody for tuning in today, and we'll catch you again in a couple of weeks.
Thanks for hanging with us.
Talk soon.